Hello, everyone. Welcome to the Wheelbarrow Profits Podcast. My name is Gino Barbaro, and I'm one of the co-founders of Jake and Gino. My guest today is Will Coleman, who began his real estate career in 2016 by investing in and self-managing single-family properties in the DFW market while working in property management for Greystar Real Estate Partners. In 2018, Will began working in commercial lending at Citibank as a credit analyst, being responsible for accurately underwriting the credit quality of borrowers, properties, and markets in Texas. Will now works as the director of Rand Cap, a mortgage brokerage which focuses on finding the ideal financing on apartments and mobile home parks. Without further ado, welcome to the show, Will. How you doing, bro?
Doing well, Gino. How about yourself?
I'm doing good. So give the listeners an idea of your journey going from college to single-family homes to community banking and now working with the big boys.
Yeah, so right out of college, I knew I wanted to get into real estate. I even purposely handled the taking care of it. I lived in a house with six other guys in college, and I took care of all the bills and handled handling the rent payments and everything, just because I kind of wanted to get the feel of it.
Mm-hmm.
So right out of college, I did what most people did, listing bigger pockets. I house hacked and had the whole rented the kids on Craigslist and did roommates, and it was a 4-bedroom house, and house hacked that with 3 other roommates, and slowly built up a single family portfolio in DFW while working as a leasing agent for Greystar Real Estate Partners, which is the largest property management company in the U.S., one of the largest owners as well. So I wanted to learn the operations behind multifamily, because I knew eventually I would want to get into multifamily.
Mm-hmm.
So while building a single family portfolio in Texas, I was also working as a leasing agent while going to grad school. So it was a busy couple of years. And as I worked as a leasing agent for about a year or two, I realized that I needed to learn the numbers behind the operations. So now I felt pretty good about the operations, and I was starting to fall in love with debt. I was starting to fall in love with leverage and how debt works and how loans work for real estate specifically. So I just started going to a bunch of different networking events and trying to find commercial lenders and saying, give me a job. So I found one by the name of Citibank in Texas, a fantastic local bank in Texas. And I worked as an analyst for 2 years there, and then slowly started to shift towards buying multifamily. And then I got connected with the Jake and Gino team, and now I work here at Rand Capital. So just kind of seeing the operations, being the analyst behind the debt at a bank, seeing how decisions are made, and then pursuing debt for my own multifamily properties allowed me to kind of see both, what the lender sees and the investor sees. And now I'm incorporating that within Rand Capital.
So why real estate for you when you were in college? What attracted you to it?
I think a lot of entrepreneurs and a lot of people that want to be successful try and find, the easiest way to get to the end. And I think I saw real estate as that. It's just basically, if you're able to purchase something, it produces cash flow, and all you have to do is manage the tenant. I was very attracted to that, and I tried a ton of things. I tried starting a billboard company. I tried starting a candle company, a loan company, so all different kinds of things. And real estate was the one that worked, and it felt like it was the one that I had a skill in, and it kind of tailored to my strategic thinking and that mindset. And then being in Texas, real estate's all about demographics, and there were so many people moving to Texas that it just seemed like a no-brainer.
So what has changed in your thoughts and realities about real estate now since when you started?
That's a good question. It's probably slower paced than I expected. So I probably got into it thinking, I was going to be standing on top of a skyscraper within 5-10 years. And I think that's a lot of young optimism, but it's a long-term play. You have to be very strategic and disciplined and patient and persistent. And that's probably the biggest thing that's changed my perspective of real estate.
So what would you say to everybody out there who says, multifamily is not for me, it's a pie in the sky, I'm going to start with single family homes? What would you say to them?
Personally, and this may be different than what a lot of people say, I think that's great. Um, I started a single family, and I still own my single family, and I love my single family. I hear a lot of people in the multifamily space talk badly about them, and I knock on wood every time I hear that, because I've had a very pleasant experience in in single family. So I would just say I think it's a great option to start small and do one unit, do 2 units, and then once you feel more comfortable, then potentially step into the larger deals.
So how do you step into those larger units?
Well, I mean, education is a big piece of it, right? And there's multiple ways of getting education. You can you can join a group like Jake and Gino, or you can kind of take it step by step and just go with the single family, and then maybe another single family, and then a duplex, or find someone in the market that is currently doing the size deals that you want to do, and offer to buy them lunch and just pick their brain. So I'd say education, either through your own experience and failures, or getting someone that can teach you.
So when you joined the Jake and Gino community a couple of years ago, where were you? Were you trying to scale up in the multifamily space? You were still working with the community bank. What were you looking to get out of that community, like you said, as far as the education? Anything else?
Yeah, I think the biggest piece for me was I was trying to surround myself with like-minded individuals. Is the phrase you hear, but I was sold on multifamily, and I would speak to a lot of people that were very successful, that had a lot of capital, but just didn't understand real estate. For that reason, they didn't want to spend the next 4 to 6 months learning it. So I just kind of was thinking, how can I find a group of people that are successful that are already also bought in on multifamily? And that was the real question that led me to join the community.
So when you first started out, you were working at a community bank. Jake and I loved community banks when we first started out. We still utilize community banks. Can you give the listeners out there some of the benefits of working with the community bank, and what your experience was with working with community banks?
Yeah, community banks are great. The biggest benefit that they have is flexibility for customers that they like. So if you build a good relationship with a community bank, they can do all different types of loans for you, different leverage, different setups, different amortizations, different interest only. They can do construction, they can do stabilized assets. So I personally really enjoy working with the community bank, especially a good one that understands what it's like to be an investor. I think, especially starting off, we're talking about going from the 2 units to the 4 units or whatever. They're going to be more willing to take a risk on you as a borrower, as a new borrower. Even though they will like to see some level of experience and at some level of the balance sheet, it's more tailored towards a new, less experienced investor. And for that reason, a lot of people starting off, I think a community bank is a great route.
So how do you start that relationship? How do you create a relationship with the community bank?
You just start calling them. I mean, start early, right? Just so take yourself seriously. Make sure you've done your due diligence on the type of property you're looking to buy, where you're looking to buy. Make sure you understand, a bank's requirements for a borrower. So make sure when you call them, you're prepared for what kind of questions they're going to ask, what they're looking for in a borrower, and that may come through just trial and error, calling them and then hanging up on you. But yeah, just do your due diligence, be prepared, and be genuine. Have your documents in order, and then give them a call and just say, hey, look, this is my name, this is what I do. I'm looking to purchase in this area. Do you think we'd be a good fit? And just kind of go from there.
So let me recap for the listeners out there how to get into multifamily or how to start even thinking about it. The first thing that Will said was demographics, and that stood out to me. He started in the state of Texas. It's a great market right now during the pandemic, and as we go forward, demographics and selecting a market is going to be key. I mean, take a look at some markets are still completely shut down. Some markets are having an exodus of people leaving. Some markets are having an exodus of people coming into it and jobs flowing into that market. So selecting a market is very important. I think the next step is to, if you want to think big but start small, start small. Start with a duplex, house hack. It does. You don't have to start with a 100-unit complex on your first deal. If you want to, great. It depends upon what your limitations are. Do you have a lot of capital? Do you have a lot of experience? Whatever that may look like. I think just starting in the space is key. You either have 0 deals or you have multiple deals. You don't just start and buy one deal and then stop if you're an investor. So the market is number one. Selecting the asset type and starting is number 2. I think number 3, while you're doing number 2, is creating relationships with real estate brokers and with community banks. Really important to start that process out early. Open up accounts with them, start talking to the decision makers in that, and not just one community bank. Try to get multiple community banks out there. That's really important. Well, what kind of questions do you need to ask these community banks? If I'm a new, investor and I'm out there and I'm trying to look credible, Jake and Gino, we teach our students. We have the 30 questions you need to ask a community bank, how you qualify them, because it's really about the sales process. You're qualifying them and they're qualifying you. So how do I qualify you, Will, as a community banker, for instance?
I think a good question, and you actually asked this, I'm stealing this from you, is, what do you want to see out of a borrower,
Mm-hmm.
right? So ask them right out of the gate, I'm looking to be a borrower. What do you like to see from a borrower? What requirements do you want to see on the net worth side, the liquidity side, what type of asset? So get a good feel for who they're looking for and what type of person, what type of asset they're looking for. And then, explain your situation. Just say, do you think we'll be a good fit? I think that's understanding what they're looking for in a borrower. I think that is huge in terms of, not necessarily qualifying them, but seeing if they would be a good fit for what you're trying to do.
And so, Will, how do I go out and find community banks? I've gotten that question from a lot of students. Like, they're not out there promoting themselves, saying, "Hey, I'm investing. I have a portfolio of multifamily. I'm doing loans." We got fortunate. We found a small community bank in Tennessee that we've been working with for the last 10 years. They're fantastic. How do you go out and find these community banks and actually get in there and talk to that decision maker? Because there's the value in it when you're actually able to make go and discuss firsthand with the person making those decisions. How do you do that?
Yeah, so first I'd say referrals.
Hmm.
If you know of anyone who is buying similar asset types in the same area as you, just go to them and say, hey, how do you finance your deals? Maybe they do Fannie and Freddie, or maybe they do community banks. And chances are they've been working with a community bank for 5 to 7 years.
Hmm.
So, ask for a referral from a local investor, or a mortgage broker if you know a good one.
Hmm.
Ask for a referral from them. They're not going to refer you to someone that they don't like or that they think is bad. So a referral is a good start. Secondly, you can just drive down, your city. If you look for banks, they're everywhere.
Hmm.
Especially in Texas, and Texas National Bank, Citibank, Texas Bank, First Banks. I mean, there's so many. So just drive down or Google community banks on Google and just make a list of 4 or 5 and call them and just say, you're probably going to get I've made this call many times, right? So you're probably going to get a front desk clerk or something like that, and just say, hey, I'm a real estate investor. I'm looking for this type of asset class. Generally, that clerk will then transfer you to a lender that specifically does that type of loan.
Hmm.
So it's actually quite easy to get in touch with multiple banks in a market. Just Google and call.
And before we transition into the agency side and Fannie and Freddie, when you're working at the community bank, what are they looking for when they underwrite a deal? And just walk us through that process. How long does it take? When they look at a deal, when do they go to a committee? All that. Give us the behind the scenes. So an investor right now who's listening to this is like, okay, this is what I need for a community bank. I need my documents. I need everything in place. I need to work fast. If I have a partner, I need to have my partner on board because he needs to have everything with me. Because once the process goes, we don't want to stall the process. So walk us through how the community banks typically underwrite a deal, what they're looking for, how long the process normally takes.
Sure. So the main thing they're looking for is how are we going to get paid back? right? That's the question they answer. And so there's three sources of repayment. That's how we would say it. Basically, there is the property cash flow. So, repayment based off the property cash flow. There is then the global cash flow. So the property, the borrower's assets, all in one cash flow. And then there's simply the borrower's personal income. So, for example, generally we would build out a property cash flow first. So that's source of repayment one. Source of repayment two would be the borrower. So based off the borrower's personal tax returns, how much income does he produce? And if he needs to pay down the debt, what's the DSCR there? And then they'll build a global cash flow. So the third repayment is going to be, the borrower's partners, the borrower's wife, everything possible to see, the total amount of income and what's the DSCR there. So we'll look at property DSCR, borrower DSCR, and the global cash flow DSCR. So those are the three sources of repayment that a bank is going to underwrite. So it's important to know, you as a borrower, if the property cash flow is great, but your personal and global cash flow will not be strong, I would say that up front to the bank and just let them know, how do you guys underwrite this? How do you mitigate this? What can we do? How can we work together to mitigate that risk? Because if it's a strong property, the global cash flow may not be that important, or this low leverage global cash flow may not be that important. So that's what a bank's looking for in terms of underwriting. And the second piece will be the borrower's personal financial statement. So just plain net worth and liquidity. So if they're buying a $500,000 deal, but their net worth is $10 million and they've got $2 million in cash, the cash flow is going to be much less relative. But if you've got $100,000 net worth and $20,000 in cash, they're going to want to see a strong three sources of repayment. So understanding, have a very realistic understanding of your cash flow and your net worth and liquidity is very important when you speak to these banks, because they will find out either way. And then in terms of time frame, the biggest piece is the borrower getting their documents to the lender. So on the front end, the underwriter, what I used to do, is going to create a document request, and they're going to send that document request to the borrower, and it's going to have a list of 15, 20 things that they're going to want to see in terms of documents. And just being ahead of the curve on that as a borrower and sending that the next day or even before they ask for it, that's the most exciting thing a lender and an underwriter can see. They're like, all right, this borrower is not going to waste their time. This guy knows what they're doing. It's not necessarily going to lead to favorable terms, but when someone likes to work with you, they'll want to keep doing business with you. So once the document has been received, it takes about 1 to 2 weeks to put the loan memorandum together. So it's basically a package of the deal. It takes 2 to 3 weeks to order the appraisal, the inspections, and phase ones. So that's a 3-week period approximately. And then at that point, you will then submit and take the loan to committee, and there'll be about 8 to 10 decision makers that will all sit around the table and vote. And they'll talk through the deal, they'll try and tear holes in it, they'll ask the analyst, they'll ask the lender, and they'll ask anything you can think of. Is he getting divorced? What is he doing in his personal time? It's kind of insane, the questions that have come out. But then everyone has a vote, and eventually, if there's no no's, the deal is approved. And that will take anywhere from 25 to 40 days, just depending on the level of documentation and the appraisal and the lending environment. Right now, it's probably going to take a little bit longer, just due to COVID and the delays of PPP and things like that. But that gives a general framework of what it looks like behind the scenes.
So we've been talking how wonderful community banks are. What are the negatives of community banks and why people should consider agency? And before you answer that, Will, at RandCap website, is it randcapllc.com?
That's correct.
So go to rankcapllc.com. You can download a personal financial statement that Will has on there. Fill it out, and that'll give you the framework of what you're looking for. I mean, it's an awesome document. You need to be prepared. So that's the first step in preparing yourself, is creating your own personal financial statement. And from there, going there, creating it, crushing it there, and going through the whole community bank process, what you're going to say to yourself is, wow, multifamily is really a partnership. It's a partnership sport. I mean, you get multiple people on it. If you don't qualify for the loan, that's why it's called Jake and Gino, because I wasn't a strong borrower and Jake wasn't a particularly strong borrower either in the beginning. I even had my brother be on our first couple of deals together because we weren't strong borrowers, but that's what we ended up doing. We ended up banding together, and it really helped out our strength on our balance sheet with the community bank. But give us some negatives. I mean, the first one, obviously, it's recourse debt. You are personally guaranteeing the loan. That's the first thing. Let me just put that out there. So from what Will was talking about, they really look at you at community bank. They're lending to you. They're looking at you as much as they are looking at the deal. Like Will said, they may be crazy loans, but if somebody's going through some personal challenges in their life, if he or she's getting divorced, or if he or she's leaving their job, moving on, there's something tumultuous going on, it may affect their ability to run this property, to pay back the property. So there's a part of risk. Banks don't like that. Banks want to lend money to people that they know don't really need it or are able to pay it back. That's the reality of the banking situation. So you have to make sure that you have a stable life. You have to make sure, not that you have just a stable life, but that you have you're dotting your I's and you're crossing your T's, important. And also creating that bio for yourself. Give them the story of what you are, whether you're a business person, whether you're working for a great corporate job, whatever that may look like, or whether you're an entrepreneur, create that story. But let me get back to the negatives. Obviously, what we said was the recourse debt. What are other negatives do you see working with community banks?
Sure. And just quickly, the link to the PFS is randcre.com/PFS.
Good. Thank you.
Yeah. So, and it's a great personal financial statement. It's best in the biz.
Mm-hmm.
So yeah, the recourse and the non-recourse is huge. Anytime you lend with a community bank, it's almost always going to be recourse, which means that they can come after your personal assets if you don't pay back the loan. So that means your any capital that you have, any additional rental properties you have, they can come after those type things. So a negative, aside from the recourse, is going to be kind of general overall terms. So it's probably going to be 25-year amortization.
Mm-hmm.
And so amortization roughly means the time period you have to pay back the loan. So the shorter the time period, the higher the payment. So that's a huge piece, especially if you're buying for cash flow. It's probably going to be a shorter term. So it's probably going to be a 5-year term, meaning that the loan, let's say you make it today, at 2025, the loan will be due. Whereas agency will be probably 7, 10, 12-year term. And longer term options are available at community banks, but it's less prevalent. So you're going to have 25-year amortization, 5-year term probably. Your interest rate's going to be slightly higher. So right now in October 2020, rates are around 4 to 4.5 for a community bank, whereas with Fannie and Freddie, it's closer to 3%. So that's a big piece. Another big piece is that they are limited on their leverage, right? So if everyone who gets into real estate, right, not everyone, let's say 80%, they don't want to do 6 deals and quit, right? They want to do 6 deals and then 30 deals and then 50 deals and then buy 100 or a 200 unit deal. Most community banks have a lending limit per borrower. It's not black and white, but they eventually will say, hey, we're not going to lend you any more money. And so community banks are great for getting started out. They're great for being flexible if you're doing a construction deal or if you want to get a little bit creative with the financing. But if you're really trying to scale and go large, there is a limit that a community bank can go to. So that's another huge negative as well.
So what you need to do is you need to go out and get a couple community banks, because like we like to say, our first community bank, we almost tap ourselves out, but then we go into a refi from community to agency, and all of a sudden we open up a few more $1 million of liquidity. So for everybody out there, when you're first starting out, don't be afraid to ask for 80% loan to value with community banks. That should be, and right now when the agency is doing 65 to 70%, communities are doing 80%. We've gotten an 85% LTV on a deal we closed a few months ago, which was fantastic from our community bank. We're getting 80% loan to cost with our community bank, which is also amazing because they're giving 80% of the rehab budget in the loan itself. So your cash on cash is fantastic. The other thing I'd say for us, on our first deal, we had our very first deal. We had an owner financing component. We had a 20-year AM. We had a 6% interest rate, and we had a 5-year term. When we refied that deal 18 months later, almost 2 years later, around 2 years later, with the community bank we have now, we got 80% LTV. We got a 10-year term on that deal because I'm looking at it right now. Because we just talking to the community banker yesterday. We didn't know if it was 5 or 7. It was actually a 10-year term on that, 4.29% interest rate and a 25-year AM. So when people talk about the refi and roll, we pulled out $160,000 on that deal, and the payments didn't go up. It stayed the same because we pushed out the amortization 5 years and we knocked off almost 2 full points on the interest rate. So when you're starting out, all you beginning investors, don't be afraid to ask is the key to this entire podcast, because community banks want your money. We can get into the fractionalized banking system where they grab $1 of your demand deposits and they have to lend out money. That's how they do it. They take $1 in and they'll lend out up to 10x. And, traditionally it's 10x. But I mean, when we were back in 2007, 2008, we'd go to 30, 40, 50x. They were lending out money like crazy, but they want your money. They want your business. They want that stability of demand deposits coming in. So for us, it was amazing when we did the refi and roll because we started out with such crappy terms, but it's one of those instances in life when you make a mistake and the mistake actually comes out to benefit you because you learn from that mistake. And we created Jake and Gino, and that's why we have the financing arm. One of the 3 elements is buy right, manage right, and finance right. And finance right encompasses all of those tools. We're not going to get into owner financing. We're going to touch on agency in a minute, but the community banks are really an amazing tool, and we've used them traditionally almost as a bridge lender where we're getting into them. We use them to get into the front end. We have that 5-year term, but then what we like to do is we'll either refinance back to the community bank, or the community banks have great prepayment penalties. They're very low. So within year 2, year 3, the prepayment penalties are low, and we'll refinance it into agency, right? So that's what our strategy has been, utilizing them as that bridge, because we've seen bridge the last 6-7 months just traditionally disappeared. So we're doing that in the deal we just closed. We went with community bank. We're probably going to hold it with 18 months. And from that 18-month period, we're just going to refinance it out to agency. So community banks, awesome to start out with. Now, let's talk about agency and the learning curve that an investor needs to actually learn about agency, because sometimes it may be hard to get into their first deal with agency unless they're using Freddie SBL, who will work with new investors. But what was the aha moment when you started with agency banks? Like, oh, wow, I can't believe this is like completely different than community banks.
Yeah, it's definitely the big boys. I mean, it's government debt. They take everything very seriously. It's not very flexible. So it's definitely the big boys. They prefer not to work with newer investors. What was the question? What was my biggest?
Well, your aha, your epiphany moment, like, wow, this is a really big difference with community banks and agency. And also, let's piggyback over that. What are the real benefits of working with agency as opposed to community?
Yeah, so the benefits are obviously the terms. So they want the deal and the sponsor to check all of the boxes. But if you can check all the boxes, the terms are basically undealable. So it's non-recourse, meaning if the deal goes bad, your personal assets won't be pulled in to pay down the debt. There are some clauses in there, basically, don't commit fraud, and it will remain non-recourse. I mean, the rates are insane. Right now on conventional deals, you can get sub 3% interest rate. So that's the cheapest money in U.S. history. You can get 30-year amortization. So again, a longer period to pay back your loan means less of a debt payment, which means more cash flow. So we're in an environment now where asset values are increasing. The only way to increase cash flow, or not the only way, but a good way to increase cash flow is by having a 30-year amortization, which Fannie and Freddie do allow. In fact, they don't do anything shorter than that. Another huge piece is interest only. So Fannie and Freddie, they're lending on stabilized long-term assets. So if you're a long-term holder, if you're planning to hold this 5 years or more, potentially even less, you know, they want to lend to you as a long-term holder, and they're willing to give you a pretty decent time period of interest only. So it's pretty standard right now for 2 to 3 years of interest only. I've seen up to 10 years, so full term interest only.
Yeah.
Which again just increases your cash flow. And a great product you mentioned is the Freddie small balance loan. So Freddie is willing to work with newer borrowers. They will require to get a third-party management company. They don't want a new borrower and a new management company working on the deal. Right now in COVID, they have been a little bit stricter in terms of newer borrowers. But Freddie SBL generally will lend to new borrowers with a third-party management company. And you know, you can get 2 to 3 years interest only on that. You can even reduce your step down to an accelerated step down prepayment. So generally on Freddie SBL, the prepay will be 5% year 1, 5% year 2. So let's say you do a 10-year term, it's 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. You can even reduce your step down so it's a 3, 2, 1, and take your interest rate from 3.5 to 3.8 or so, which is still better than the community bank. And then you're still getting all the non-recourse, the interest only, the 30-year amortization. So there's some great options for those 30, 40 unit deals with Freddie SBL. With agencies, the terms, I guess besides HUD, which HUD is a whole other beast. The terms are just if you're serious about holding these properties and producing cash flow, the terms are very difficult to beat.
So this is why it's really important for the listeners out there to really get educated on multifamily, because Will is talking about exit strategies and types of debt. So we won't go into this podcast, but if you want to hear any more of this, just go to the Jake and Gino channel and look at all the other podcasts we've done and the blogs we've written on finance. Right? He's talking basically about the 3 pillars of real estate. He's talking about the market cycle where we're buying these assets, the type of debt you're going to get on it, and the exit strategy. So when you're looking at prepayment penalties, are you going to hold this for the full 10-year term? So then maybe you don't get stepped down. Maybe you go for what we call yield maintenance, right? That's really important to envision. And that's when you're looking at the 3 pillars of real estate, you're really looking at the deal holistically from your advantage point, from what you're trying to accomplish. And it's what we call the buy right portion of it, right? You're buying this asset. Is it a good deal? Okay, it's a good deal. Now, the second component is, what kind of debt do I need? Do I want to go with community bank on the front end? Does that make more sense because I'm going to refinance this property out? Or do I want to go with agency on the front end because I'm going to hold this thing forever, buy and hold forever? That you have to really look at it yourself and create that strategy and create that recipe for yourself. Because that first deal that Jake and I bought, it's over 7 years ago that we bought that deal. Our strategy was to buy and hold forever because that's all we knew. So we went with community. The loan was sub $1 million, so we couldn't get that deal with agency. Very important. It's something that we didn't mention. Community banks are great because they'll work with smaller loans. I think that property is worth over $1 million now, so we could refinance it to agency probably, but it's a mixed-use kind of property. It's not one of those stellar properties. That's why we got owner financing on it. It was amazing. But that deal, we still own that deal. It's got another 5 years left on the term. We're paying down the principal on that deal. We're cash flowing $6,000 a month net every month from that very first deal because we bought it right. We had the right exit strategy because we want to hold it forever. We refied that deal, and we also put the right debt on that deal. The community bank was excellent. So when you're looking and going and just working through the deal itself, I want everyone to figure out what part of the market cycle their city's in. Because every city's in a different part of the market cycle. You're going to be buying different assets, whether they're newer, they're older. That's really important. The second part is you really got to think about your exit strategy. Are you going to refi this deal out? Are you going to sell this deal out? Are you going to hold it for the long term? And then from there, you're going to go to your mortgage broker. And that's the question I really want to get into. I know Will's got a great resource, so I want him to share the resource. But how do you qualify your lender? The 7 lender questions. I love that framework that you put together. Share that doc with the listeners, and also walk them through. I want to work with Will right now. What kind of value should your mortgage broker bring to the table?
Yeah, so one is really just experience in consulting. I mean, the benefit that a mortgage broker will have is they're working with multiple lenders at once. So, like for example, right now, I mean, we're doing a mobile home park deal, we're doing a retail deal, we're doing multifamily refinance, we've closed small multis, we're looking at scattered site deals. And these are mostly with different lenders. So, let's say we've got Extensia, Arcadia, Capital One, Arbor. So there's multiple lenders we're working with in different asset classes in different areas with different borrower experience. So the biggest piece is, let's say a borrower goes directly to one lender. That one lender is probably very good at one thing, and they're very good at telling you that one thing is the best thing. And it's just they're incentivized to sell their product, so they're going to do that. You can't hold them fault at that. And any salesman has that intertwined with him. But a mortgage broker has the benefit of having multiple loan products and consulting you specifically on your property. So if you're looking at a specific type of deal, we can talk about your plan. We can talk about the market cycle. We can talk about how you're buying it and your exit strategy. And then we can say, now that I know, what business plan you're operating with, we can then go and say, okay, we think Arcadia is going to be the best option for you because I know firsthand they're willing to do a smaller loan. They're willing to do this type of deal in this area for this type of borrower. Whereas Capital One, they're not going to be super enticed to do this type of deal. They really prefer to do larger deals. And I also know, by the way, Capital One is jam-packed. They're, and I'm just making up names. I'm not using these specifically. But certain lenders will be very busy at times. They'll be going through things with the company. And certain lenders will be very hungry for deals and are willing to do, those types of deals. So any mortgage broker is able to understand these different types of lenders, what they're doing, and kind of tailor fit the lender that we choose to go with based off your deal, your environment, your experience, and what you're trying to get out of the debt.
So where can the listeners get a hold of that doc to qualify the lender?
It's 7 Lender Doc. Where is that? That's on the Jake and Gino website.
It's on the Jake and Gino website. You can go to jakeandgino.com/resources. And on the resources page, we also have an acquisition doc. Also, we have the 7 Lender doc and we have the personal financial statement. Those 3 resources are really crucial and they're key to start your success to begin to finance right. Because you have to understand, once you've done the finance right portion of the framework, it's done. It's not like manage right where there's the wheel and it's in constant motion. If you've bought the asset properly and you're financing it properly, those 2 legs are completely done and taken care of so you can focus on the manage right portion. That's really important. Now, when you're going into it, I want to caution everybody when they're working with mortgage brokers, and I've seen this a lot in the industry. A lot of them like to overpromise and underdeliver. They will quote you, yes, I can get you 80% LTV on an agency loan. Well, right now, it's not happening. Unless you're a multiple gazillionaire where you've done tons of deals, that's not really going to happen as part. So I would say to you, when you're shopping for mortgage brokers or you're out there, have them give you a term sheet. Have them give you, and you said 80%. So when they come back, they're going to retrade and go, oh, you know what? I couldn't get 80%. I'm going to do 75%. How do you tell the listeners, Will, to avoid that? Because it happens a lot. I'm going to give you, 7 years IO. Oh, wait, I can only give you 3 years IO right now. The term is, I can give you 12 years. Oh, now I can only give you 10 years. How do you have the listeners avoid those kinds of putting themselves in those kinds of situations?
It's hard, right? I mean, it's very difficult. I mean, especially if you're an investor and you're trying to produce a certain level of returns and you talk to 2 lenders and one says 75% loan to value and one says 80, and they're very confident that they can get 80, right? Your returns are going to look significantly better than the one that says 80. So you're just like, we have to go with the one that's saying 80 because they're going to give us the best level of return. So in that scenario, I feel for investors. It is difficult. And there's a lot of lenders in this space that will do that. I guess the best way to vet that is to, one, get a second quote. So if you get one that says 80, go to the one that says 75 and go to them and say, hey, they're promising me 80. Why can't you do 80? Do you think they can perform on 80? And if so, why not? Or if not, why not? And then go back to the lender that's promising you 80. Like, hey, the other lender says for this reason, 80 is not possible. How are you mitigating that reason? And if they don't have a great response, at some point you have to make a judgment call. And I will say something that I think makes Rand Capital a bit unique is, we're investors as well. So, we know what it feels like to tour property, to submit an LOI. We know what it feels like to, be counting on a lender to produce a certain level of leverage and interest and time frame. And I know exactly what it feels like to speak to a lender and say, hey, can you do this? And working with them to make sure that they can provide the outcome that they're producing. And, we keep that in mind on the loan side. So when we're providing quotes, when we're talking with investors, I speak to investors as if, I was the investor. I'd rather be told the truth, and I'd rather be told what is realistic rather than, a sales pitch that's going to get you in the door. And we have lost deals because of that, but, that's our motto is ethics and execution, and that's what we stand on.
So for all the listeners out there, the other thing you can do is you can go out and get multiple referrals from other investors. Ask other investors what lender they've worked with and what results they've gotten. And if they've ever gotten retraded. Hey, I worked with this lender here. He told me he can get me 75% and he did, or he told me 80%. So you can go out there, and that's why, joining a community like Jake and Gino or any other community out there will help you with that, because those investors and those members in that community are going through what you're going through, and they can give you the referrals also. So that's really important as well. Let's take a quick time out to hear from our sponsors. This is Jake's favorite part of the show, and unfortunately, I'm flying solo today, so I'm going to take this part myself. Jake loves to ask, "What's your best habit for success?"
Oh man, meditation. Absolutely, I think meditating provides peace of mind and ability to handle stress like no other. It's been my key to success for sure.
What do you love about the lending environment, and what do you not love about the lending environment?
So what I love is that debt is the circulatory system of the economy, and it's important to keep your finger on the pulse. I'm trying to tailor that quote, but every single piece of debt every single piece of property for the most part has debt on it, and understanding that system, I think, is very valuable to understand what's really happening in real estate. So I love debt just because it is so prevalent. It's the blood system of the economy. What I do not like about it, it's not an easy industry. There's a lot of moving pieces. There's a lot of things that change, and it's very difficult to make good decisions. There's a lot of goalposts will move. Things will happen during due diligence. There's a lot of difficult conversations. But at the end of the day, you can do a good job and really benefit an investor. So, I would say the moving goalposts and the difficulties of the industry, especially in today's environment, is probably the hardest part.
I think all the listeners on the show understand the importance of debt and the difference between business debt and personal debt. All entrepreneurs out there, we need to use business debt and lever the business portion of our balance sheet to live our personal balance sheet. So when you're out there hearing that somebody has $400 million of debt, it's probably debt on their assets that are being paid by cash flowing assets. So understanding that is important. And when you go back to any financial crisis, you'll see the debt market seizing up and then saying, oh gosh, I can't get out there and get a loan. Like Will said, the circulatory system of the economy, it truly is. If we can't get debt on a property, and you'll see when interest rates rise, you'll see all of a sudden your property's prices are going to drop, because you're going to say all of a sudden the debt on this property is costing me more. The cost of capital is costing more. So when you're seeing us go into recessions, traditionally they would drop interest rates, make money easier to borrow, and they would do the vice versa. When you go in, when you're in your crazy economy, they'll raise rates just to slow it down a little bit and to reset asset prices. Going forward, not sure if that's going to happen because we have so much debt on our balance sheet right now. If we go to 5 or 6 or 7%, don't even know how the government's going to pay that. But that's traditionally what's happened. So all the entrepreneurs out there need to understand and utilize debt, because $1 of debt today you're paying it back 5 years from now is worth a lot less 5 years from now. So that's why it's important. Don't subscribe to the Dave Ramsey model of just killing all of your debt. Understand how to utilize it. It's just like the finance. It's just a tool in the toolbox. If you're buying something and it's giving you a yielding asset and you're getting cash flow from it every year and you're able to pay it off 5, 6, 7 years from now with dollars that are a lot cheaper, you're way ahead of the game. So understand the finance component. It's really important. Will, any book recommendations?
I mean, Atlas Shrugged is easy go-to, right? I mean, I read that at a young age and really enjoyed that. One I just read, I would recommend. It's called Good Economics for Hard Times. It talks about a very different topics, so like immigration, income inequality. It talks about taxes, and it was written in 2018. I think it's a very good economic policy book.
So when you say income inequality, how is that affected? I was speaking to somebody, and what when the Jake and Gino students said is, the middle class derives a lot of their wealth from their home. And when you buy your home properly, you have equity in your home, you're able to utilize that equity. So even the middle class, when they tap into debt and they utilize it properly, you can really create a ton of value and net worth for yourself. And then how you utilize that is if you're going to go on a vacation with your equity and do whatever, but if you're reinvesting that equity is what you should really be doing out there. So touch on that book just a little bit more as far as income inequality and as far as debt. Did they go into that in the book?
It doesn't touch on specifically in debt. It more so gives a historical framework of income inequality and what's changed over the last 100 years or so, as well as it compares it to other countries and their ability to mitigate or not mitigate income inequality. And it's a very tough topic, so I don't know if I know it's a ton about it to talk about, but it does seem that there's an increase in income inequality in America. And I do think you're right. I think a big piece of it is a lack of quality education and the ability to understand how to use debt the correct way. Mm-hmm. If you use it incorrectly, it can really hurt you. So, people that are starting small businesses, being able to use debt correctly, I think is a very good tool that could be better taught to the majority of the public. Getting credit cards at a young age and using them correctly, things like that really improves, the ability to get debt long term.
I want everyone to listen to this, what I'm going to say for the next 2 to 3 minutes, because it's vital to your financial future. Because of Jake and Gino, people with financial intelligence can change the world. That's the reality. I think right now we have a class warfare right now. Right now, what's going on is the people who are financially intelligent, like the Bezoses of the world, like everyone out there who is creating companies, whether it's the Peloton companies, whatever that may be. Back in 1971, we got off the gold standard. All of a sudden, the currency is worthless. The currency is worth 90%. You've lost 90% of value from what it was in 1970. 1970, a cup of coffee was 25 cents. Now it's $2. So basically, your money is devalued. Now, our parents who bought homes back in 1970 at $22,000, $25,000, the rate of inflation is just an increase in the money supply. That's what it basically is. But inflation leads to prices increasing. That's the end result. So for no fault of their own, what they did 40, 50 years ago, they went out, went to college, got a great job. They saved some money because savers back then were earning 10, 12%. They were winners back then. And we weren't taught to utilize debt because it didn't make sense to utilize debt. You have money in the bank, you're making 10% on your money, and you buy a home. So that home back in 1970 at $20,000, you go to New York, wherever, it's worth $500,000 now. So through no luck of their own, through the rate of inflation, through the devaluation of the currency, they became wealthy. Now they're selling those homes, and that's now for us to start out at that point right now, we're buying a home that's so overvalued right now, and we're not out there being savers. We can't save money because you're making less than 1% and you're not velocitizing your money. So right now, the people who are winning are the ones who are velocitizing their money, getting the money and putting it into the economy and making it work. And they understand that money is just a tool, right? It's just a tool. Debt is just a tool. We need to utilize that to create. And I want everyone to put these two words on their vision board if they have it. You're either a producer or you're a consumer. That's what it comes down to. All the entrepreneurs are out there trying to produce as much as possible so they can consume. What the middle class does is we get money, we consume, and then whatever else is left, maybe we'll produce something, whether it's buying a little rental property or buying mutual funds. No, but most people who are successful, I mean, I love MJ DeMarco. Everyone should check out The Millionaire Mindset by MJ DeMarco. Great book. We've done a podcast with him. He really hit me home a few years ago. And when he said that most entrepreneurs and most people who are wealthy, they think about producing. They're not worried about consuming, because what happens is the excess of production and the way they've created these businesses will allow them to consume. And you're able to save that money and invest that money into another asset. Whereas most middle class people, like I was taught, I would save money into an account and utilize that for the event instead of saving money and buying an asset. That asset would produce me cash flow. And then that cash flow or that yield would pay for the event. That event is over, paying for my daughter's college. The next event is up. My son's going to college. I still have that asset continuing to produce, right? That's really important. That is the key change that we've had in the last 40 to 50 years, in my estimation, of what's been going on with the economy. So not much has changed that way, but when you're devaluing a currency and you're adding extra dollars into the market, that's why multifamily is fantastic. You're buying a hard asset. You're buying something where you can control the revenue stream. You want to raise rents, you want to fix the property up, you want to refinance the property, you have the control of it. And that's what's happened in the last 30 to 40 years without people understanding it. That's why it's much harder for the middle class. Even if they get a 3 or 4% raise in income, doesn't matter. Your rents are going up by that much, because when you're getting more money into the economy, it's inflation, which causes prices to rise. All of our prices rise. So you're getting a 3 to 4% raise. I mean, good luck with that. I'm just saying, beware and go back and read history and see what has happened over the last 50 years. And I will promise you're like, I can't believe it. And then that's the only way you're going to have, like I asked Will before, your epiphany moment by going, I need to become an entrepreneur. I need to start investing in my education, because it's an investment. It's not a cost to learn all this stuff. You're investing in yourself and you will always have it. Then you can make decisions about allocating money into certain vehicles, whether it's real estate, whether it's whole life insurance, whether it's crypto, whatever that may look like for your portfolio. But at least you can take control of your life. That makes sense to you?
I love that. I think the only thing I would add is that wealth comes from equity and ownership.
That's right.
And that's a huge mindset shift that I had. Is I'm willing to put all my time and effort in right now into owning equity and ownership in something, rather than just working, trading time for money. So
and we can all do that. Everyone can do that. The question that you need to ask yourself, whoever's listening out there right now, are you working hard for your money, or is your money working hard for you? Now, if you're working hard for your money, there's nothing wrong with that, because the fallacy of everyone saying, oh, it's a 4-hour work week, that's ridiculous. First of all, I love working. I don't want to work 4 hours in a week. I want to work a lot more because I love what I do. But things take a lot of work to get off the ground, and then they continue. And then when you've got that venture off the ground, you'll become bored and go, oh, let me go try this venture. And then, oh, let me go try this venture. Let me start another podcast. Let me write another book. Let me create another event. That's how life really is, because you get better at something and you become more passionate about it. But working hard is truly important to start it out. But then when you start working hard and you start generating income, then you say to yourself, is your money working hard for you? Every dollar you need to deploy and need to have that dollar work harder for you, learning how to work harder for you. You're leveraging money. Remember that you're leveraging the value of your money and making it grow. And that's one of the most important things that I can, leave everybody with. Are you working hard for your money, or is your money working hard for you? If you're number one and you're not thinking about number two, you're going to get stuck in the rat race. To get out of that rat race, have your money start working hard for you. Will, how can the listeners get a hold of you?
Best way is email. My email is will@randcre.com, WILL@RANDCRE.com.
Everybody out there, if you're looking to finance a deal, email Will. He will walk you through the process. It's one thing to go out there and just get a quote. It's another thing to have somebody be an advocate for you, to walk you through the entire process, especially if you're a first-time borrower or second-time borrower, or if you just had a bad experience with the borrowing process. We've had bad experiences. Sometimes it's the economy, sometimes it's just the process itself, sometimes just unknown factors. But if you want to have an advocate and you want somebody to walk you through the process, be sure to reach out to Will. Thanks, Will, for taking the time out today. I appreciate it. And let's just go out there and make it happen, my friend.